Welcome back to The Explainer, everyone. Today, we're putting on our financial auditor hats to take a grand, exclusive tour through the Reserve Bank of India's Capital Registry. If you really want to understand how a nation tracks its wealth, its investments, and its global financial standing, well, this is exactly where the magic happens. We're going to decode this whole system, step by step.
Okay, let's jump right into the foundational concept here. The capital account is, at its core, just a massive, incredibly systematic ledger. It meticulously records all international economic transactions that relate to changes in assets. And we're talking about both financial paper assets and actual physical, tangible ones. Short-term, long-term, private official, it doesn't matter. The capital account fundamentally tracks the shifting stock of a nation's total wealth. So here's our visual blueprint for today's audit. We are going to walk through the 6 distinct pillars the RBI uses to classify these capital flows. We'll start with foreign investment, then move through global loans, banking capital, rupee debt service, other capital, and we'll finish up with monetary movements.
But before we crack open those pillars, we have to establish the golden rule of the registry. It's actually pretty simple. Whenever money flows into the country, allowing us to acquire foreign currency, that is recorded as a beneficial credit. Conversely, whenever money flows out, meaning we're spending or exporting capital, it's marked as a debit. Inflow is a credit, outflow is a debit. Keep that rule front and center as we go through this. All right, let's hit Pillar 1, foreign investment.
Now, foreign investment generally comes into very distinct flavors. On the one side, you have direct investment. This is super hands-on. Think of a foreign entity actually acquiring control of an Indian company, building physical manufacturing plants, or buying real estate. Then on the flip side, we have portfolio investment. This is much more hands-off. It's essentially just purchasing financial paper, like buying shares in companies or snapping up government bonds without seeking any active operational control. And applying our golden rule, you can see exactly how the RBI records this. When non-residents invest their cash into Indian companies, whether that's direct or portfolio, that's an inward flow. Boom, credit. But if Indian residents decide to invest their money abroad in foreign firms, that capital is exiting the country. It's an outward flow, and therefore, it's logged as a debit.
Moving right along, we step into Pillar 2, global loans.
Here, the registry shifts focus from equity over to debt, dividing loans into external assistance and commercial borrowings. This covers everyone, private individuals, the state, non-financial institutions, and the accounting logic stays beautifully consistent. Borrowing money from abroad, capital flows in, so that's a credit. But if we are the ones lending money abroad or we're paying back our own foreign loans, capital flows out, and that hits the registry as a debit.
Next up is the third pillar, banking capital.
This one's fascinating because it zeroes in on the mechanics of domestic commercial banks, specifically their overseas branches. It captures their foreign exchange dealings and the investments in foreign currency that those foreign branches make. Crucially, this is also exactly where the RBI tracks deposits made by non-residents, so it really acts as the central hub for monitoring international banking liquidity.
All right, let's step into Pillar 4, rupee debt service. Now, here is a curveball for you. How exactly do you pay off a foreign loan using domestic rupees? I mean, in international finance, borrowing usually means you have to settle the debt in foreign currency, right? So how does this specific pillar even work?
Well, it's actually a pretty brilliant, almost barter-like sequence. Sometimes a loan is explicitly designated in rupee terms right from the get-go. To pay it back, the debt isn't just settled by wiring cash. It's repaid through the literal physical export of goods and services. We export tangible items to service the loan, which ultimately creates an indirect flow of foreign exchange. It's this highly specialized, self-contained transaction loop.
Which brings us to Pillar 5, other capital.
Look, every meticulous accounting system needs a safety net, right? A catch-all. Any international capital movement that just doesn't neatly fit into investments, standard loans, banking capital, or that specialized rupee debt, it lands right here. This pillar guarantees that absolutely no capital flow slips through the cracks.
And finally, we hit the vault door. Pillar 6, monetary movements.
Here's where things get real. You need to understand this concept called disequilibrium. When you tally up all the credits and debits across the balance of payments, it almost never balances perfectly naturally. We either end up with a surplus, meaning a favorable balance with more money coming in, or a deficit, which is unfavorable because too much money flowed out. When things are in this state of disequilibrium, the RBI actually has to step in and manually fix the scales.
To force the books back into equilibrium, the central bank pulls some massive levers.
These monetary movements mostly come down to two actions: executing purchases and repurchases from the IMF, the International Monetary Fund, or making direct, calculated changes to the nation's own stockpile of foreign exchange reserves.
Think of the nation's total foreign exchange reserves kind of like a giant pie. If there's a deficit, meaning way too much capital flowed out, the RBI can dip in, slice a piece off, and inject those funds to accommodate the deficit. On the flip side, if there's a surplus, they can absorb that excess foreign exchange and basically bake a new slice into the reserves. It's the ultimate balancing mechanism to keep the ledger steady.
And there you have it, the whole shebang. From the initial tracking of direct and portfolio foreign investments, all the way down to those manual, corrective monetary movements, these 6 pillars collectively support and track the nation's entire capital account. Together, they ensure that every single cross-border change in assets is meticulously recorded.
Before I let you go, though, I want to leave you with a quick thought experiment. We've just seen how outflows are marked as debits. Well, if capital just continuously flows out of these pillars as a massive, constant debit, what ultimately happens to the free market value of the domestic currency left behind? Think about how that outward pressure might directly dictate currency depreciation and shape the global exchange rates we experience every single day. Something to chew on. Keep analyzing those flows, and I'll catch you in the next explainer.